welcome. It's this week's Tuesday Q&A again, and I hope you find this interesting. It's come from one of our viewers in Australia. Hugh from Sydney was in a discussion in relation to current interest rates and low yields and investing in Australian residential property. And his question is a great one. He said, look, at these prices, are Australian investment properties really investment grade at these low yields? So, as always, disclaimers are important because this is obviously general information, and just as with this question, everyone's scenario is personal and different. So that's why we always suggest that you either get personal advice for yourselves or give us a call and we can arrange a Zoom meeting to go through the situation. So let's look at Hugh's question in a bit more detail. He's from Sydney, so I could assume from his question that he's referring to Sydney property. So investment properties in Sydney certainly have become more expensive, as we all know. Certain property markets around the country, in fact, just about all of them, have gone up since the advent of COVID, and then the discussion late last year and early this year about further easing in monetary policy, and that remaining in the system for much longer. So we're going to have potentially this updraft in property prices and other growth assets going forward for at least the next few years. But if we look at Sydney investment property, yes, prices are higher and yields are probably the lowest of anywhere in Australia, any of the markets around Australia, and they vary quite a lot. So if we look at places like Darwin, so perhaps the worst performing property markets over the last number of years, which have been Darwin and Perth in terms of the capitals, are now performing better in terms of price increases, albeit from a very low level, and therefore rental yields generally tend to be higher because they're an inverse function of capital values. So Sydney is the opposite. Prices there are much higher, yields are much lower. But when we look at these things, we've got to look at it in terms of the overall. So you can't just say, are they investment grade because of these low yields? And furthermore, I think it's a really good time to think about doing your research because they're not that low in all markets. And Sydney, being sort of in the high 2% is at the lower bound of that. But you don't necessarily need to go to perhaps Darwin, where you're looking at say a 7% rental yield, gross rental yield, because that doesn't make the investment grade. Because you're trying to obviously not only get an income yield from your investment, but capital growth. So if you're going to invest in a good business, shares in a good company, you would be doing so to get a reasonable dividend yield, but obviously you would like the value of that business to expand over time, especially over the longer term. Similarly with property, as with any other investment. So let's look at that, take back a step and say, okay, in actual fact, these yields aren't that low, because if I put my money on term deposit in the bank, what am I going to get? 0.25% perhaps? So if I can find quality residential investment property in Australia that's in sought after areas and the right type of dwelling, and I can get a yield of say 4% plus as a gross yield, many people would find that attractive. And I think it is attractive in the current financial universe that we find ourselves in, this low yield world, as they say. They're pretty attractive yields, depending obviously on your expenses, etc. But if you find quality dwellings, whether they be apartments or townhouses or houses, you've got to look at the expenses of all of these and then try and work out, again, get assistance with this, work out exactly what your net yield is likely to be and how that compares with other forms of investment. Then look at what your potential capital growth might be over the years from buying that property. And if you add those two parameters together, generally speaking, you can come up with a pretty good outcome. And that's, well, the outcome comes over a period of time. So don't try and look for the same outcome every year, because it's not going to happen. It will fluctuate. Values fluctuate, rental fluctuates, and we've got to look at the macro drivers behind that too, because as we all know, immigration has been a key in terms of what's driving property values and rental values in Australia. So that's been a big boost and a big tailwind for Australia. And currently, obviously, immigration has come to a standstill. But I think the government is working fairly hard in terms of providing some new initiatives to kickstart those things for us in the coming year. As an interesting point, 2020 was only the 8th year that Australian population growth actually had a fall since 1788. So an interesting statistic, and I'm sure one that gives people an indication of how consistent this has been. If you like, the adjunct to that is that I think that immigration will really kickstart once international borders open, because I think the way Australia has handled the pandemic and the outcomes from that really makes it an even far more attractive place for people from other countries to try and migrate to. So I think that will then be a bit of an elastic situation where there's a lot of pent-up demand, and we're seeing that now in lots of areas of different economies. So I think that will also come through and then flow through in terms of that ongoing population growth, which will again put some more upward pressure on housing demand. So if we look at that, always remember that you've got to maintain some sort of unique attributes to your investments, so your investment properties, make sure it's sustainable, make sure they are in sought after areas, and that they appeal to the owner-occupier market in Australia, because that is really going to be the market that's potentially going to buy your investment from you further down the track, should you ever decide to sell. And in terms of, I guess, rental demand, it gives you a far more consistent approach, which has been exemplified by the fact that a lot of people that have bought, and I call these investor grade, small apartments in really large buildings in city CBDs, they've really suffered the brunt of the shortfall in rental demand, because most of those dwellings were being occupied by students who were coming from offshore, a lot of them from Asia, China in particular. So those places have been hit hard, they haven't recovered, and regardless of that, we always say to people, try and buy dwellings, and if you are going to buy apartments, buy larger ones that are built for owner-occupiers in boutique buildings that are oversized, that appeal to people, and stay away from, city CBDs. I always like that sort of 3 to 13 kilometre inner middle ring, as I call it, in especially the East Coast capitals, because you'll find over time, if you buy the right properties in those locations, you're going to end up with a much better overall outcome. And they're actually very hard to find. So one more thing I might add into Hugh's original question here is supply and demand. If you look at what's being built at the moment, the level of apartment approvals is actually 50.8% below its decade-long average, whereas if freehold residential housing in terms of, if you like, house and land situations is up 33.3%, or a third above its decade-long average. So what's really been driving this is first home buyers taking advantage of different state and federal government grants to build houses. Generally speaking, obviously these are in the outer rings of capital cities where land is still cheaper, and the apartment side of things obviously is more widespread, but generally again comes back down to the CBD regions where a lot of these investor style small dwellings were being built that had quite often challenged floor plates, etc. So the things you don't really want to own. But if you try and buy a nice apartment that's oversized, built for owner-occupiers, just go out and try and find one in Sydney, Brisbane or Melbourne. It's very difficult, and if you do, you're generally paying a pretty high price for that. So these are all the things that people need to bear in mind. It's nothing to do just about what the yield is, because generally speaking, if you get a lower yield, it will be more than compensated for by higher capital growth over time. And at the end of the day, most people really would benefit more from capital growth than from income, especially the way the Australian tax system operates. So on that note, anyone else who has questions about that, please let us know, and we can go through different nuances or different, if you like, segments of that in future Q&As. and I hope you found that interesting. I'll see you again next week.